Welcome to Market Movers. I'm Jim Uriel, and today we're focusing on Europe with the Dutch election and tomorrow's Bank of England meeting. We're looking at using euro currency options as a means of hedging risk or increasing exposure to these events. Joining me today is Chief Investment Officer of Kingsway Asset Management, Scott Martin.
Hi, Jim.
Scott, is the Dutch election important, and why?
Well, it's very important because I think it speaks to the stability or the future stability, Jim, of the Eurozone. This is one of many elections that's coming up very soon, and therefore, depending on how this election goes, could pertain to how other ones go as well.
Kind of like a trial balloon for Europe, so to speak, with the French election coming up next week.
Absolutely, and that's affecting things like the currency, the markets, etc.
Now, the Bank of England. England's had solid economic data lately, but they've also stepped closer to triggering Article 50, which would be closer to Brexit. Are they going to keep rates low?
I think they're going to keep them low, but I do believe this monetary stimulus, the stability, the support that the ECB and the BOE have provided the markets is more closer to the end than it is the beginning, and that's something to watch, especially when you look at the currencies.
Okay, now before we dive into trade discussions, I'd like to point out that with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to manage risk or create additional exposure, not as trade recommendations. Prices and movements will vary in the markets. When we're pricing these out now, the June euro currency is trading 1.0750. Scott.
So the euro's been really interesting, Jim. Anybody you talk to is pretty much short the euro, it seems like, doesn't it? And that has been a boulevard of broken dreams, thank you very much, because all the euro's done in the face of bad fundamentals is rally. So I looked up a few put spreads. They were kind of expensive, so I punched up a call spread today. 107.5, 108.5 call spread. This expires the week 4. This is week 4 March expiry. It's going to cost you about 34 ticks to put it on with a potential reward of 824. So it's going to cost you about 426 to put this trade on, in the sense that the euro news is already baked in and the euro is bound to rally, especially after what happened with the LC today.
Right. I like this trade. I'm going to give a similar one. And prices are saying that it's breaking out of a range to the upside. The euro is. I've never been an enormous fan of the way European economic policy is played out and how they seem to kick their problems down the road. But I follow price more than I follow the fundamentals, because the price might be saying that it's already all baked in. So I'm looking at buying the week 4 March 108, 108.5 call spread for 13 ticks. This trade has an expiry of March 24th, like yours as well. It has the June contract underneath, presently trading at 107.50. Trade risks $162 to make $462. The reason I like this better is because it risks less. It's less likely to happen, but if it does, we have a greater reward.
Correct. And mine's a little closer to that underlying price level when we price this out. So maybe it doesn't have as much reward in it. But the FOMC move today was really interesting from the standpoint of the good old greenback. It got smoked, even though they confirmed that they may have to be a little bit more hawkish going forward as inflation data comes in.
They came out and said 3 hikes in 17, where the market, even though they'd never said 4, the market had kind of been leading toward 4, which I thought that was interesting. And the dollar got pummeled.
Yellen, for the first time in a long time, said we might have to rapidly hike interest rates if inflation starts to really pick up. That is a really big tell.
Well, thanks for joining us in this special edition of Market Movers. I'm Jim Uriel, where we're helping to make you a better trader.